Let me ask you something. The last time you made a large withdrawal from your bank, maybe to buy a car, pay for a home repair, or move money between accounts, did anyone at the bank tell you that transaction might be automatically reported to the federal government? No heads up, no phone call, no letter in the mail, just silence. And somewhere in the background, a file was quietly sent to Washington with your name on it. If that sounds alarming, it should get your attention. Because right now, millions of retirees are going about their daily banking completely unaware that federal law requires their bank to report certain financial activity directly to the IRS and to FinCEN, the Financial Crimes Enforcement Network, often without ever informing the account holder. And if you're living on a fixed income, drawing down retirement accounts, receiving pension checks, or managing savings built over a lifetime, some of those perfectly normal, perfectly legal transactions may already be raising flags inside a federal database. This is not about anything illegal. This is not about tax evasion or fraud. This is about everyday retirees, people like you, unknowingly triggering reporting mechanisms that were designed to catch criminals, and then finding themselves staring down an IRS notice because they had no idea the rules even existed. Hey, welcome back. I'm Finn Whitfield. So today we're going to break all of this down, clearly and honestly. Which transactions get reported, what forms are involved, what the IRS actually does with that information, and most importantly, what you can do right now, legally, to make sure you stay fully compliant and never get blindsided. Stay with me through this entire video because what we cover toward the end is where most financial advisors don't take the conversation, and it could genuinely save you from a very stressful situation. And if you're new here, welcome to the Finn Whitfield channel. We cover real retirement money topics that actually matter for your financial life. Hit that subscribe button right now so you never miss a video, and let's get into this. Let's start with the foundation of all of this, a law called the Bank Secrecy Act. Passed back in 1970, this law was created to help the federal government track large movements of cash. The idea was simple. If someone is moving big amounts of money in cash, law enforcement needs to know about it. Drug traffickers, money launderers, tax cheats, this law was aimed squarely at them. But here's where it gets complicated for retirees in 2026. The law doesn't only catch criminals, it catches everyone. And the primary tool the Bank Secrecy Act uses is something called a Currency Transaction Report, or a CTR. Under this law, any financial institution is required to file a CTR with FinCEN, a division of the U.S. Treasury, anytime a cash transaction exceeds $10,000 in a single business day. That means cash in, cash out, or a combination of both. If the total exceeds that threshold in a single day at a single institution, the report goes out automatically, within 15 to 25 calendar days of the transaction. Now here's the part most people don't know. Your bank is not required to tell you it filed that report. You won't get a phone call, you won't receive a notice. The report goes straight to the government, and you continue your day completely in the dark. That CTR includes your name, your date of birth, your account number, the amount of the transaction, and the type of transaction. It's an extremely detailed snapshot of your financial activity. Think about what that means for a retiree. Say Walter, a retired school teacher from Ohio, decides to withdraw $11,000 in cash from his bank to pay a contractor who only accepts cash payments for a kitchen renovation. That is a completely legal transaction. Walter has every right to withdraw his own money, but that withdrawal automatically triggers a currency transaction report. Walter never hears a word about it, and suddenly there's a federal record connecting his name to a large cash transaction. Now here's where things get even more important. Some retirees, after learning about the $10,000 threshold, think the logical solution is to just break their transactions up into smaller amounts. Take out $4,000 here, $4,000 there, $3,000 a week later. Problem solved, right? Absolutely not. In fact, doing that intentionally is a federal crime. It's called structuring, and it's specifically prohibited under the Bank Secrecy Act. You don't have to intend to commit a crime for the bank to flag this behavior. You just have to make multiple transactions that appear to be designed to avoid that $10,000 reporting threshold. And banks are trained to look for exactly this pattern. When they see it, they're required to file a Suspicious Activity Report, a SAR. Unlike a CTR, which is triggered purely by the dollar amount, A SAR is filed when a bank suspects something unusual is happening, even if each individual transaction is only $5,000 or more. In fact, the SAR threshold sits at $5,000 for funds suspected of involving illegal activity. That SAR gets filed with FinCEN, and again, you are never told it happened. The investigation, if one occurs, moves forward entirely without your knowledge. As the law currently stands, banks are legally prohibited from disclosing to you that a SAR was filed. The key point here is not to panic about CTRs. If you make a large, legitimate cash transaction, that's completely fine. It gets reported, and if everything is above board, nothing comes of it. The issue arises when the activity doesn't match your financial profile, or when it looks like you're deliberately trying to stay below reporting thresholds. That's when a routine filing can turn into a more serious inquiry. There is some news on this front worth knowing. A group of senators introduced the Streamline Act in late 2025, which would propose raising the CTR threshold from $10,000 to $30,000, since the current threshold hasn't been adjusted since 1972. But as of right now, in 2026, that bill has not been passed into law. The $10,000 threshold is still very much in effect. Always go by current law, not proposals. Now, cash transactions are just the beginning. The far more common issue for retirees involves something different entirely: informational reporting through tax forms. And this is where the IRS matching system comes in, and it is far more sophisticated than most people realize. Here's how it works. Every year, your financial institutions, your bank, your brokerage, your retirement plan administrator, are required by law to send certain forms to the IRS. Not to you first, to the IRS. Then they send you a copy. By the time you sit down to file your taxes, the IRS already has a detailed record of what you received. Their computers then cross-reference what you report on your tax return against what those institutions already told them. If the numbers don't match, the system automatically flags your return for a notice, or in some cases, an audit. Let's walk through the forms that matter most to retirees. The first one is Form 1099-R. This form is issued by any financial institution or plan administrator that distributes money from a retirement account, traditional IRAs, 401ks, 403bs, pensions, annuities. The form goes out by January 31st of the following year, and it covers everything you withdrew during the prior year. Box 1 shows the gross distribution amount. Box 2A shows the taxable portion. And crucially, Box 7 shows a distribution code that tells the IRS exactly what kind of withdrawal it was, whether it was a normal distribution, an early withdrawal, a rollover, a Roth conversion, and so on. Here's where retirees get tripped up. If you take a distribution from a traditional IRA and roll it over to another account, you have a 60-day window to complete that rollover tax-free. But the 1099-R still gets issued showing the full amount as a distribution. If you don't properly report the rollover on your tax return, using the correct code and the right line on Form 1040, the IRS sees a large distribution come in on their end, sees no matching income reported on your return, and sends you a notice. Not because you did anything wrong, but because the paperwork wasn't handled correctly. This happens to thousands of retirees every year. The second major form is the SSA 1099. If you're receiving Social Security benefits, you get this form each January. What surprises many retirees is that depending on your total combined income, up to 85% of your Social Security benefits can be taxable. The IRS receives this same information and is looking to see that you've accounted for it properly on your return. The third is Form 1099-INT. Your bank is required to report any interest income you earn over $10 during the year. Yes, $10. If you have a savings account earning any meaningful interest, that income is going straight to the IRS. In a higher interest rate environment, retirees with significant cash savings are earning real money on their accounts, and every dollar of that interest is tracked and reported. Form 1099-DIV works similarly for dividend income. If you hold stocks, mutual funds, or ETFs in a taxable brokerage account, your dividends are reported, both ordinary dividends and qualified dividends, directly to the IRS. The distinction between ordinary and qualified dividends matters because they're taxed at different rates, and misreporting them is another common mistake. The IRS matching system, formerly called the Information Returns Processing System, runs automatically. It doesn't require a human to look at your return and decide to question it. The computer does it. And when there's a mismatch, the system generates what's called a CP2000 notice, a letter that says essentially, "We received information that doesn't match what you reported. Here's the amount we think you owe." That can include back taxes, interest, and sometimes penalties, all from what was very often an honest reporting error. Now let's talk about required minimum distributions, RMDs, because this is one of the most common areas where retirees run into trouble, both with the IRS and with their overall tax situation. Under the Secure 2.0 Act, which was signed into law in late 2022, the required beginning date for RMDs was raised. If you were born between 1951 and 1959, you must start taking required minimum distributions from your traditional IRAs, 401ks, and most other tax-deferred retirement accounts in the year you turn 73. If you were born in 1960 or later, that age goes up to 75, but that change doesn't kick in until 2033. So right now, in 2026, if you're 73 or older and holding a traditional IRA or 401k, you are required to withdraw a minimum amount every year. That amount is calculated by dividing your prior December 31st account balance by a life expectancy factor from the IRS Uniform Lifetime Table. At age 73, that factor is 26.5 years, which means roughly 3.7% of your balance must come out annually. That percentage increases each year as you age. The critical thing to understand is that your plan administrator files a Form 1099-R for your full RMD amount. The IRS knows exactly what you were supposed to withdraw. If you don't take your RMD, for whatever reason, that missed distribution is subject to a 25% excise tax on the amount you failed to withdraw. If you catch the mistake and correct it within 2 years, that penalty drops to 10%. But the IRS has your number, literally. They know what you owe yourself, and they know if you didn't take it. This came up recently with Walter again, same retired school teacher, different headache. Walter turned 73 in 2024 and knew he had to start taking RMDs. What he didn't realize was that his delay in taking his first RMD, waiting until April 1st, 2025, which was technically allowed as the deadline for a first RMD, meant he had to take a second RMD by December 31st, 2025. 2 RMDs in the same calendar year. Combined, those 2 distributions pushed Walter into a higher income bracket than he expected, made a larger percentage of his Social Security benefits taxable, and increased his Medicare Part B premiums for the following year. All of that was perfectly legal, but it blindsided him because no one had explained the cascade effect. That's exactly the kind of thing this channel exists to help you understand before it catches you off guard. Let me talk about one more area that doesn't get nearly enough attention in retirement content: the IRS's Information Matching System, as it applies to large lump sum movements. Think about a pension payout, a severance distribution, or a large IRA withdrawal you made to cover medical bills or help a family member. These transactions appear on your 1099-R as large gross distributions. The IRS sees them. Their computer is programmed to ask, was this reported? Was any withholding applied? Does the distribution code match the circumstances? When retirees take large one-time distributions, even for completely legitimate reasons, those transactions are visible to both their bank and the IRS simultaneously. The bank may have flagged the wire or cash withdrawal under the Bank Secrecy Act. The plan administrator filed a 1099-R. The IRS matching system is running its cross-check. You're visible to multiple federal systems at once. Again, this is not a reason to be scared. It's a reason to be prepared. The IRS audits less than 1% of all individual tax returns in any given year. According to data covering recent tax years, that figure sits at roughly 0.4% of all individual filers. But that rate rises significantly as your income goes up. If your total income debt from Social Security, pension, IRA distributions, interest, and dividends combined climbs into the higher brackets, your audit probability climbs with it. And for retirees specifically, the IRS has flagged several areas of heightened scrutiny: unreported retirement income, missed RMDs, foreign account holdings, and mismatched 1099 information. So what do you actually do with all of this? Let's get practical, because there are clear legal steps that help you stay compliant, reduce your exposure, and actually use these rules to your advantage. The first and most important step is to report everything. Every 1099, every distribution, every dollar of interest. The IRS matching system is not about catching complex tax shelters. Most of the notices it generates come from simple mismatches, a 1099-R that wasn't entered correctly, or a bank interest payment that got overlooked. Go through every document you receive between January and early February, match it against your tax return, and if anything doesn't align, fix it before you file. Second, understand your rollovers. If you move money from one retirement account to another, make sure it's done as a direct trustee-to-trustee transfer whenever possible. This means the money goes directly from institution A to institution B, and no 1099-R gets issued. If you take the money yourself, what's called an indirect rollover, the bank withholds 20% for taxes, you only receive 80%, and you have to deposit 100% of the original amount into the new account within 60 days, or the whole thing is treated as a taxable distribution. Direct transfers eliminate that entire problem. Third, for those who are 70 and a half or older, consider qualified charitable distributions. If you have a traditional IRA, you can direct a distribution, up to a significant annual limit set by the IRS, directly from your IRA to an eligible charity. That amount counts toward your RMD for the year, but it's excluded from your taxable income. You don't even have to itemize to benefit from it. This is one of the most underused tools in the retirement tax planning toolkit, and for retirees who don't need all of their RMD for living expenses, it can meaningfully reduce your taxable income and potentially lower your Medicare premium bracket. Fourth, keep documentation for large cash transactions. If you make a significant cash withdrawal, even a legitimate one, keep the receipt, note what it was for, and hold on to any related records. If the IRS ever does ask about a CTR that was filed on your behalf, being able to show clearly what the money was used for resolves the issue quickly. Most CTR inquiries go nowhere because the transactions are entirely legitimate. It's the unexplained transactions that create problems. Fifth, and this is especially important for retirees with accounts at foreign banks or investments held overseas, make sure you're meeting all of your foreign account reporting requirements. If you have foreign financial accounts that exceed $10,000 at any point during the year, you're required to file an FBAR, a foreign bank account report, with FinCEN by April 15th. Failing to file that report, even without any tax liability, can result in penalties that are completely out of proportion to what the account was worth. The IRS has made international tax compliance a clear enforcement priority. Here's the bigger picture that I want you to walk away with. The federal reporting infrastructure that surrounds banking and retirement income is not going away. If anything, it's getting more interconnected. FinCEN, the IRS, and financial institutions share more data today than at any point in American history. Every retirement distribution, every interest payment, every large cash movement, it's already logged. The system is already watching. But the watching itself is not the threat. The threat is being caught off guard. The threat is a retiree like Walter sitting down in April, opening a letter from the IRS, and realizing that a transaction he made 9 months ago, something he thought was completely private, has now triggered a notice he doesn't know how to respond to. Knowledge is the protection. Understanding how these systems work, what they're looking for, and how to structure your financial life clearly and consistently, that's what keeps you out of that situation. The rules are knowable. The compliance path is clear, and once you understand it, you can actually manage your retirement finances with a lot more confidence. One more thing. There is legislation floating around Congress, the Streamline Act, that would raise the CTR threshold from $10,000 to $30,000, arguing that the current limit is outdated and creates far more paperwork than actual law enforcement value. That proposal has support, but it has not become law. Until it does, $10,000 is still the line. Do not adjust your behavior based on what might change. Plan for what the law actually says today. If you found this video genuinely useful, I'd ask you to do two things. First, leave a comment below and tell me, have you ever received an IRS notice related to your retirement accounts or banking activity? I read every comment on this channel, and your experience might actually help another retiree watching right now who's dealing with the exact same situation. Second, share this video with someone you know who is retired or getting close to retirement. I mean it. Share it right now, before you forget. This is the kind of information that takes 5 minutes to share and could save someone years of headache. Most people in their 60s and 70s have simply never been told how these reporting systems work, and that gap is costing real people real money. And if you want to go even deeper, we have a full video on how the IRS matches your 1099s to your tax return, step by step, and what to do if you ever receive a CP 2000 notice. Link is in the description. Watch that one next. I'm Finn Whitfield. Stay informed, stay protected, and I'll see you in the next video.